Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast, sponsored by Ralph Lauren. I'm Billy and I'm joined by my co-host
Andrew. Bills, we're back again for another podcast and we've got a sponsor on board.
So if you're out there listening, Ralph Lauren, just feel free to hit us up. We're taking sponsorships. We've got sponsorship packages on offer. Be more than happy to talk to you guys.
Yeah, as you can see, we're already consumers of your product, so you don't need to sell us on the benefits.
And to our viewers and our listeners, no, we do not have sponsorship. We will not be flooding you with ads and sponsorship messages at this point in time. But if you want to give us some money, we'd be more than happy to take it.
Exactly right.
All right, maybe we should get on with the task at hand, Andrew.
Yeah, exactly right.
What are we talking to everybody about today?
So today we're back for our second segment that's going to be a regular on the show, which is a market update. So running through a bit of info around what's transpired, what's been happening in investment markets over the last month or so, how things have been tracking, and what are the big things that are happening.
Yeah, and look, I think this is timely and it's a great segment, and this was based off some feedback that we got from someone, but it's fantastic because I guess at the moment in particular, there seems to just be so much happening and so much to talk about, which is great because there is a lot of things happening, there's a lot of noise, and I think getting some clarity and working through what they are and what the potential impact and ramifications of those are will help people feel more confident with what's going on.
Yeah, absolutely. Guess first point to start is the US personal consumption and expenditure, so PCE data had come out, which is basically a measure for inflation, and it came back higher than expected is really the big headline thing. So the big worry there, and one of the big concerns for investment markets, which is kind of part of the reason why investment markets perform the way that they did over the last month, is the fear of inflation, and that it may be around for longer than what we expected and longer than what some economists have been predicting over in the US. So definitely some concern around that.
Yeah, and I guess it's different. We need to be mindful about the time that we're recording this and also the time of the data as well too. So we're recording this on the 10th of March, so we usually record a week in advance of when we publish. The data that we're talking about is for February, in particular in this case, but the data that came out, just to give us some context here, for the Australian data for Feb, it was actually better than expected. So I guess the thinking from the central bank's perspective is that we're starting to see inflation soften in Australia, or the indicators of it soften in Australia, whereas in America it's a different story.
Yeah, exactly right. Which kind of poses a bit of a conundrum for reserve banks, and I'm sure we'll get onto it later on. But it's a bit of a little bit of a conundrum for reserve banks in Australia, so the RBA, because Fed's increasing rates because they're trying to curb inflation. So Australia kind of wants to move with that, but when you're already in a position where inflation's starting to curve off, you're usually slowing down in terms of your interest rate rises. So bit of think work there in terms of what they're going to do and whether they're going to continue with the rise in rates, and whether they're going to continue to move in lockstep with the US or start to deviate from that strategy as well.
And I guess it's important to point out as well too, the reason why we're starting with the US is because they're the leading economy in the world and they seem to set the pace and the tone for the rest of the world. So starting with the US definitely makes sense. The other thing that we've seen that's been interesting, and it's probably in the media a little bit more, is the layoffs, especially in the tech sector in particular. They seem to be the businesses, I guess, most of the time that tend to lead in terms of what's happening with the economy, because they're at the cutting edge of, I guess, the products and the services that we use. But we have seen a large number of layoffs, specifically in the tech sector. All of those big name technology companies over there, and they're laying off people, which would indicate that there's a softening in their economy.
Yeah, again, which is, it's kind of met with mixed emotions. Sort of one of the big things that has been I mean, it's a good thing for individuals. Sometimes it's good for the economy. Sometimes it's viewed as a bad thing for the economy. But unemployment's been historically, has been at massively low levels. And so what that does is it pushes inflation further because people have money to spend. So some of the cuts that we're seeing in the tech sector are being viewed as a positive thing for investment markets, which is really weird because you usually don't, see layoffs as a positive thing from an investment standpoint. But it's also a necessary aspect to help curb inflation. Just the extent of it, how far that continues, is really going to be a thing that we're going to need to look out for in investment markets.
Yeah, and I guess if you think about that from a timing perspective, maybe the businesses are doing that, which is then an indicator of where the economy is going to go. So it could potentially be that we're in this difference between the two things that we're seeing, still seeing larger inflation data in the US and seeing the unemployment rate or the unemployment in a particular sector increase. Maybe that's just setting the tone for what's to come. So it'll be interesting to see sort of what happens over the next little bit, specifically in the US, when the next round of inflation data comes out, and also when the next round of job data comes out as well too.
Yeah, exactly right. Sort of putting that all together and looking at, S&P 500, so top 500 companies over in the US, we're down 5.46 over the course of really the month of Feb. So US stock market is down. It's been very volatile. We're seeing investment markets that have been performing both positively and negatively. Last month, a 5.46% decline in investment markets is quite large. So I think that's going to be the way of the future as we kind of, figure out whether this is going to be a soft landing as everyone continues to talk about.
Yeah, I mean, look, just interesting on the returns. Investment markets are a reflection of where a group of investors think the economy is going to go in the future. So if we're in a greater time of uncertainty, which it's fair to say that we are, then you're going to see that volatility reflected in the market, and that's exactly what I think we saw with the S&P 500 in February. So it's not surprising. And then if we get positive data, you might see it swing back the other way. As an example, I think January was really strong in terms of the numbers out of the US stock market, as well in Australia as well. But that's just a reflection of the uncertainty that we've got right across the board as well too. Andrew, bond yields, where are we at with those? Because ordinarily they weren't getting a lot of airtime.
Yeah. I mean, look, we did really see a massive bond collapse with rising interest rates. Obviously, conflict over in the Ukraine. So bond yields bond valuations took a massive hit. We're starting to see bond yields rise, and so we're really starting to see them almost hit new heights, post collapse. So bonds are starting to look like a potential buying opportunity for investors as well, which really haven't been present sort of over the last 12 months or so.
Yeah, yep. We'll see where that one goes in relation to interest rates.
Yeah. Exactly right. Sort of doing the round around the world before we get to Australia as well. We're also seeing some deterioration in the Chinese economy.
Yep.
Something that we was not overly expected, considering that there was a large scale lockdowns and whatnot in manufacturing in China. So the reopening hasn't been quite as positive as what we expected. So as a result of that, and I guess one of the big things with that impacts the Australian economy is Australian resources. They're obviously a massive consumer of Australian resources, and so the resource sector in Australia is down as a result of it. But also from a world economic perspective, whenever you kind of consider that the largest manufacturer in the world, or one of the largest manufacturers in the world, is experiencing a decline and showing some signs of a slowdown, that's always a bit of a concern as well.
Yeah, and that really could be two things that I just want to unpack with this. I mean, it could be that we're seeing consumer spending slow down simply because the cost of everything due to inflation has increased. That's the first thing. And because interest rates are increasing across the world to combat inflation, in Australia in particular, the American mortgage market is different because a lot of the borrowers are on fixed rates there. But it could be that we're seeing that people have got less income to spend, and you're seeing a slowdown in the Chinese market. That's what I suspect is happening. The second thing is, which I think is worth talking about too, which is the issue that we experienced as a worldwide economy throughout COVID. Supply chains broke, supply chains collapsed. And as businesses, and we'll use Apple as an example, we've got the phone there, so I'm looking at it, but think of Apple as an example. They were having issues getting their products manufactured from their factories in China. So one of the things that they're thinking of doing, and not saying that this is the impact and why we've seen a slowdown in China, I think this is going to be a longer play, but they're starting to think about how do we bring manufacturing either back onshore or at least closer to where we need those goods, primarily America in this instance, because we don't want to rely on an overseas supplier in the event that something happens to our supply chain. It basically completely ruins our business.
Yeah.
So that'll be an interesting one. And that takes time for that to sort of flow through. But that could be an interesting longer term headwind that China faces, I imagine, and countries that are really heavily focused on manufacturing.
Yeah, absolutely. Absolutely. COVID's definitely changed the way that people and businesses really think, because that's never really been a consideration or a concern in the past.
Yep, absolutely.
Yeah. Sort of moving a bit closer to home, Australian market sort of kind of in lockstep with the US, but Australian market down a bit over 3% over the course of the last 12 months. So Australian market isn't necessarily faring any better than what the US is, maybe slightly better.
Yep.
But we're really seeing the impact to business around what's been happening from a worldwide perspective, both in the form of consumption, consumer spending, all of that stuff, as well as outlook moving forward, really impact investment markets over the last month.
Yeah, and just a little bit further to that, the Australian market does take its lead from Wall Street, so it's not surprising that if we're seeing a negative return in February for the S&P, we're also going to experience that on the ASX here as well too.
Yeah, absolutely.
Yep.
Absolutely.
Yep. Reporting season.
Yeah, it was a really interesting, or some really interesting takeaways. And I think when you really kind of sit there, and you don't really need a finance background to analyze it or look at what you'd expect would happen, and that's kind of what has happened. What we've seen is reporting season's kind of come to an end, and as a result, there's been an increase in revenue. So businesses have reported an increase in revenue, but their margins have been a lot weaker. So despite the fact that businesses are earning more money, they're actually making less profit. Now, kind of you wouldn't expect that's what would happen, because naturally as a business you'd expect that in the normal course of things you're making more money from a revenue perspective, and you're going to be making more money from a profit perspective, but really what that's reflective of is businesses are paying more for materials, businesses are paying more for labor, their costs have increased, and they've been able to pass on a portion of those increased costs to consumers, but they haven't been able to fully pass on that cost to consumers. So as a result, businesses are earning a higher revenue, so they're making more money from a revenue side of things, but it's not actually translating in profit. They're actually making less profit than what they were before. Look, where that moves to, whether the consumption slows down and as a result businesses have to start making more redundancies, and so we see unemployment take a further hit, or whether businesses are able to sustain those reduced profit margins, is really going to be the thing that comes out moving forward. But it's definitely a very interesting scenario, and it's something that hasn't necessarily been a huge concern in the past.
Yeah, well, and I think that this comes back to the whole inflation question and the whole inflation piece. And this is the challenge that the Reserve Bank and the central banks around the world are trying to prevent. Because essentially, in this instance, you've got inflationary pressure on a business. Their input costs are higher, which means that their expenses are higher. They've managed to make more sales because of, I guess, consumption, and maybe because the price has gone up, but they can't keep those two in check, and what's happened is their margins are suffering. If you look at that equation, it seems to be inflationary right across the board. Inflation potentially has pushed the price of whatever the good or the service is that they're selling, and in terms of their input costs, labour, rent, materials, you name it, it's also pushed that up. And the gap between what they sell for to a consumer, and the gap that what it's cost them to make has gotten smaller. Whereas ordinarily as a business, you'd want to at least maintain your margin, if not improve it and increase it.
Yeah.
And if that continues, and just sort of, the little piece on inflation, but if that continues and it doesn't slow down, and this is the challenge and the things that the Reserve Bank are concerned about, but is it worse for 30% of the population to experience higher interest rates on their mortgage? Or is it that 100% inflation starts to run, and then 100% of the population is impacted by higher inflation?
Yeah.
And that's really what they're trying to prevent happening, because it also becomes a self-fulfilling prophecy as well too, where if you're going to buy a good or a service and you expect it to pay more, you'd be more willing to do that.
Yeah.
And then when it translates into your life in terms of what you do on the back end with that, your expectations, you might go, if you own your business, you might increase your prices. If you work for somebody, you might put pressure on the business to increase your salary. If not, you might go look somewhere else and try and bid your salary up. So it's sort of this self-fulfilling prophecy that can occur as well too, that the Reserve Banks are trying to keep in check as well.
Just perfect segue into the next point. And if you are living in Australia and you haven't heard about it, you must be living under a rock. RBA rose their interest rates again. So it went up another 0.25%. So that happened both in February and in March, which brings us to 10 consecutive interest rate rises, which is a fair whack.
Definitely a fair whack if you consider where it was, 10 months ago. And then everyone likes to kick the heels into the RBA governor as well too, but there was no interest rate increases until 2024, and geez, hasn't he got that one wrong?
Oh, massively.
Yep.
But yeah, definitely impacting mortgage holders.
Yep.
It's impacting people that have debts, which is, as you mentioned, about 30% of the population, and it's having a dramatic impact. I mean, we're seeing it even, and I know that this is a market wrap segment, and so our client base is not, a sample size of or reflective of the whole market, but it's definitely something that we're talking to clients about on a daily basis. I must say, yes, there's volatility in markets. Yes, there's concerns around property markets and all of that stuff that's happening as well. But the number one conversation, at least with my clients that I'm really having, is around cash flow. What are the impacts of the interest rate rises? How's that impacting my cash flow? How's inflation impacting my cash flow? People are very focused on that now, and it's an area that's of concern for a lot of people. Yeah,
and that's the thing. I mean, inflation has that impact, and whether you've got a mortgage or not, you're going to feel it. But then you go and couple that with people that do have mortgages, and all of a sudden you're kind of experiencing increases in the cost of everything right across the board. It's starting to have an impact and starting to bite. I guess because we are doing this, we were talking about February, but we did get the March data that came through. The commentary from the RBA, I think, is really positive in the sense that they're going to be guided by whatever the data tells them. And the data that we've seen that's come out at the start of March, it's pointing towards inflation softening. Inflation's still too high, but they are starting to talk about when the data tells us to, we're going to consider pausing and just taking a wait and see approach, because it does take some time for the interest rate increase lever to sort of wash its way through the economy and actually make its way into the data set for the changes that consumers are having in terms of their behaviour and their spending.
Yeah, exactly right. Especially when you talk about, the fixed rate cliff that people are talking about. So once mortgage holders that have been on a fixed rate, which most of those are expiring this year, come out of that fixed rate, move on to a variable rate, and are feeling the full impact of those RBA cash rate increases, that's going to have a significant impact to household budgets, household spending, and how people view money that they have.
Andrew, well said, well summarised.
Thanks, Bills. Great to jump on another podcast, give everyone another market wrap around what's been happening both in Australia and around the world. And thanks again for jumping on. It's always been a pleasure.
Thank you, Andrew. And for our listeners and our viewers, like and subscribe so you can follow all of our updates. For those of you who can't see it because you're not following on YouTube, we're wearing Ralph Lauren tops, hence the reference to them as a sponsor. Hint, hint. But no, if you need any information or want to talk about your financial circumstances, reach out. We're always more than happy to have a chat, and we'll catch you on the next one. Thanks for listening today. If you have any questions on what we've talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial